Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show then. Vineeta Sharma of Narnolia Financial Advisors, Senthil Manikandan of Newberry Capital, and independent investment advisor Vivek Mawani join me on the show. Today on Hot Money, we'll discuss stocks like Siemens. Now, Siemens came out with numbers. The stock is down 5% because 2 days we've seen a rally that's come in. What should one do with Siemens now? Page Industries has corrected all the way from levels of 36,000 to 25,000 now. Is it a good time to start accumulating? You have counters like Shankara Building, which actually has corrected significantly from the all-time high, and we're asking our guests to name one stock they believe is attractive in either the hotel or the entertainment space. So that's something that we're asking, but we'll start with the big one, and that is Siemens. Now, Siemens came out with numbers over the weekend. Financially extremely strong set of numbers. It's posted its best revenues since the second quarter of 2012. So it's taken them almost 26 quarters to get in a number back to the number where they were. But there are two things on Siemens. First of all, the counter did rally 10% ahead of the earnings, and that is why the sell-off is there. And the second thing that's impacting the stock is the MSCI exclusion, which will go on till the end of the month. So that's the two reasons why Siemens is down in trade. But how do you make the number, and what should one do with Siemens going ahead? That's something we'll ask our guests. So, Senthil, I'll start with you. Siemens, the numbers, how did you find them, and what's the way ahead for Siemens?
So, I think the numbers were in line with other capital goods majors like ABB and L&T. I think, both all these capital goods majors have posted quite a top line growth, so which was lagging in the last 2 to 3 years. I think now, if you look at even the corporate sector banks, I think most of them is expecting like the private sector capex is slowly coming on stream. So far only the government has been providing the growth. But coming to Siemens particular, I think in last, if you look at, they have ended the year with September quarter. So if you look at the order book wise, order book to sales is around 1 times. And if you look at the main verticals, I think they are selling 2 of their verticals to their parent. With this mobility and other vertical goes out, I think 15% of the revenue will be going out next year. And we have to wait out what valuations they are selling this business. So year on year it's not comparable. But if you look at the last 5 years or 10 years track record, the track record hasn't been in line with the valuations that the company is currently trading, because ROE of around 12-13%, sales and profit growth has been around flat. So just being a MNC, I think trading it around 40 times trailing 12 months doesn't look lucrative from the investor point of view. So I could rather prefer ABB, which is also in the same space, and it has all the verticals and includes railways also. And the management is more focusing on the export side also. I think if you look at the valuations wise, I think both of them trading at the same 37-40 times on trailing 12 months. I could rather prefer ABB versus Siemens.
Okay, ABB over Siemens. Vineeta, what did you make of Siemens numbers, and what's the outlook ahead?
So Siemens, as you said, it has posted very good set of numbers. Revenues, after a long time, we have seen, say, 24%, 24.5% top line growth. On a full year basis, the revenues were up around 15%, and margins also improved. Order book backlog is around 12,350 crore right now. But overall, we, as Senthil was also suggesting, that yes, we are seeing some private, capex building up. Lately the execution has been a little slower, and if we look from that angle, if you look at the valuations of Siemens, that doesn't still provide a lot of comfort, and this is the first time such kind of a revival, I would say, is coming in Siemens. So we can wait and watch some more. And instead, on the capital goods sector, which is seeing some kind of a revival, I would suggest buying Siemens India.
Okay.
Because management has also guided it has revised the guidance on the upper side, some 10 to 15% in the domestic growth, and in the export they are witnessing growth in the Latin America, Africa, Middle East. The export growth is around 3 to 5% guided forward, which which was in a lackluster phenomena for all these period. So I would suggest instead looking at Cummins.
Cummins India. Okay, ABB and Cummins. And Vivek, I think we've had this discussion earlier also on Siemens when they demerged it. Does your view remain on Siemens that that time you had said that there were issues with corporate governance and how could they do that? What do you make of the numbers and what's your view now?
Well, I still have the same issues. Basically, I'm not comfortable with the management philosophy and their corporate governance and transparency and treatment to minority shareholders, according, it's my personal opinion, leave a lot to be desired for a global conglomerate like Siemens. I mean, they have repeatedly in the last 10 years restructured their business, hived off businesses from the listed entity, which is Siemens India. But a lot of that restructuring and hiving off was not a result of the parent company also exiting that business. The parent company continues to do business, but they just move it out of the listed entity, Siemens India, which denies me as a minority shareholder the potential growth of the business that goes out. Recently, that is about early part of 2018, the mobility and railways business was moved out of Siemens India, and it was not the first time they've done it. They've probably done it third time in the last 10 years of a business moving out of the listed entity. In terms of clarifications for rationale, the valuation at which the hive off was happening, whether Siemens India was adequately getting compensated, left a lot of answers, left a lot of unanswered questions in terms of which I would have expected the management to be, or somebody from the parent company to be more clear as to why these things are being done, because probably a lot of those actions the directors or the management of Siemens India also probably has no control over. It's just being dictated by the parent company sitting in Germany. So for me it is simple. I mean, if an multinational has got very little respect for the minority shareholders, then for me whatever the business growth quarter by quarter, or I'll just leave that opportunity, because I'm not sure whether that growth is going to continue, whether that business is going to continue, or maybe it's going to move out a couple of years down the line. I'm being fair that globally promoters will enrich themselves or do things at the cost of minority shareholders from time to time. So then it is a personal view whether you want to stick with those companies, and the ownership actually doesn't matter. Doesn't matter whether it's a multinational or a foreign company. I mean, even an Indian promoter could very well have done that. Okay. So it's a personal preference that I will not stick around with such companies or promoters. So I'll just let Siemens pass by, even if there is a terrific opportunity from here on.
Okay, so I think that's the consensus view that we're getting in on Siemens at this point of time. It's a consensus thumb down on Siemens. Better to go in with companies like Cummins and ABB is something that our guests are talking about. The next one is again Page Industries. Now, when it was growing, it got that multiple, but all the way it's corrected almost more than 10,000 rupees. It was trading in excess of 36,000 when it got included in the MSCI last time around, and that is where it moved from levels of 31,000 right up to 36,000. And then when the entire market corrected, Page also corrected, and with a disappointing second quarter number, the sale of shares was aggravated. So now still despite dropping 10,000 bucks, the valuations are no longer cheap. But we're asking is for a quality business, is it time to start accumulating Page Industries? So Vivek, I'll start with you only. It's down 10,000 rupees now. I think before also we've spoken to a lot of guests. They say that value for quality business you need to pay value. Now that you're getting it 10,000 rupees cheaper, will you wait for a correction now or will you accumulate Page?
Okay, so let me put that thing in perspective. I mean, say over the last 5 to 7 years, Page in terms of earnings has delivered about 23-24% compounded annual growth rate over the last 5 to 7 years. That's been consistent quarter after quarter with very high dividend payouts, because much of the cash profits is actually operating cash flow, and which is actually free cash flow, given that limited reinvestment needs that they have needed. But the stock price has compounded at more than 50% over the same period, and that has been a result of expansion, terrific expansion of multiples, which was, the stock was maybe trading at about 25 times earnings sometime in 2012-13, or even as recent as 2014. 2018, it has been trading at close to 90 times earnings just a couple of months ago, before the stock price corrected. The stock price has corrected from more than 36,000 to now about maybe 25-26,000 range. So almost a 30% price correction. And what we have also coinciding with this is the earnings are also slowing down. Although the business is a terrific franchise play on consolidation between unorganized, unbranded to branded, both in it's what is innerwear is a very large part of the business, but now it's also they're also into casual wear with track pants and t-shirts and all of that, and from men's they've also moved to women. So there's expansion of the portfolio. I have no doubts the earnings growth, albeit at a slower rate, will continue. But I'm not sure whether that expansion of multiple that we saw, expansion of valuation multiple that we saw in the last 5 years can sustain. So worst case, earnings will continue to grow, but a stock price may stay in a range, and hence your multiples over a period of time become more reasonable. Worst case is what we have seen in the last 6 months, a very sharp fall in stock price with disappointing earnings, which itself will compress the multiples. But one thing is certain, this 70 times earnings will not sustain for a very long time if the company doesn't deliver very high growth rates in the foreseeable future.
Okay, so that's the view on Page Industries by Vivek. Before I move on to the other guest, just marking some of the flashes that are there on the screen. Supreme Court refuses to halt Binani Cement sale to Ultratech Cement. So again, after the big news that came out, Binani is now going to Ultratech. So Dalmia Bharat Group's firm, their plea has been rejected. So that's another matter closed. So Binani will go to Ultratech Cement. So that's the view that's coming in. Vineeta, Page Industries, what would you recommend your clients to do at this level at 26,000?
See, we have always been recommending once Page gives a correction of 15 to 20%, it's a buy. And now that Page has actually given a correction, definitely the volumes are flat. And this time the top line or the bottom line is growing just by 10%, which the market is accustomed to see 25% plus top line bottom line growth. And management has reiterated that this time around there were certain hiccups in the GST related things, as well as the festive season getting delayed in the third quarter, which has caused some volume loss. The concern is towards the menswear segment, which contributes around 52% to the top line, and there the volumes have contracted. But if you look at it, the overall product portfolio of Page Industry has been widened. See, a company, if you look at it, the leisure wear segment is improving. They have introduced the kids wear segment. So a company which has given 25% top line, 30% top line year after year for so many years, definitely a time has come when they should, that kind of a growth will sustain only if you add on some product to the portfolio or do some engineering to your sales. Any kind of, either the product side or the marketing side. So some engineering is required, which I think Page is doing, and we are very confident. See, 1 or 2 quarter blips in the earnings is very common. We have seen for many companies. So this is the first time this kind of jolt has come to the earnings. But I would say that Page still has a very great business franchise. They are planning to increase the outsourcing to 50%. Right now it's just 28 to 29%, and that would add value to the business in the sense their working capital will reduce, which will give enough strength to the balance sheet of Page Industries, which is already very strong. So I would say people should start accumulating Page at this level and have confidence in the management. I think growth is one thing. It might take a quarter or more to revive, but then looking at the business strategy and the management pedigree, I would say it's a good bet to have.
Okay, what about you? Would you accumulate Page Industries at this level?
No, I think still it's taking expensive valuations, because if you see the last 6-7 years, like Vivek mentioned, I think the valuations have re-rated, and also majorly because of the consistency in their earnings growth.
Yeah.
But now if you look at the Q2, what were the expectations for double-digit volume growth, but the volume growth was nil, like a flat volume growth. Majority of the revenue growth came in because of the realization increase. But going forward, if you look at the industry ways, I think ABFRL with its new innerwear brand is also coming. They are very aggressive in this segment. they're also launching their new women's innerwear also. But like Vineeta mentioned, I think they have a great franchisee, and they recently got extension of their license till 2040. So there is a around next 10-15 years long-term growth prospects are there. But even if you assume a 20% revenue growth, and if there is a 1 or 2% increase in the margins, so the bottom line may grow at 25%. So if 25% bottom line growth for the next 10 years, if you assume, then investor, if you ask to make at least a market return of 12-13%, he has to exit at a PE of 40 10 years from now. So at a 40 exit multiple, it sounds like for a good business, I think 40 exit multiple looks good. So for a 12-13% kind of returns, one has to take a major risk of a single. That doesn't look lucrative from my point of view.
Okay, so that's the view that's coming in on Page Industries. I think everyone's agreeing that's a great company, but still some of our guests do have issues as far as valuations are concerned for Page Industries. Vineeta, however, believes that at this level you should start accumulating Page Industries for the long term. Now the next one is interesting. Shankara Building came out with an IPO. It was a blockbuster IPO, and the counter started moving up significantly, went all the way up to even higher than 2000 levels, and then a big correction came in. Today it's managing to hold on, but it's trading near its 52-week low. It's given negative returns of in excess of 50% on all parameters. So is there more potential downside? Would you accumulate Shankara Building at this level is something we're asking. Vineeta, I'll start with you. Shankara Building, any view?
So Shankara Building is not in our coverage, and I don't have a very clear view on the company, and I would go not rated as such. But whatever I have seen over the, it's not in our full coverage, but whatever soft coverage we have, the top line and numbers have been pretty low because of Kerala floods, which has impacted the inventory of the company. But if you look at the business, the company is giving around 2.5% net profit margin. So the margins are very low, and the company has been, I felt the company has been a little slower on the retail outlook, retail stores growth. Say it is right now it is 134 or so, and they have added some 5 stores in the last 6 months, and they are going to add some 5 more in the next 6 months. So plus if you look at any retail business, inventory is a very big challenge, not only with Shankara, with any kind of retail business. So you've seen Raymond, we have seen Trent. So inventory management is a very, very important factor, because you're already working on a very thin line of margin. So 2.5% net profit margin, and if there is something with the debt of 340 crores, so if anything wrong goes on the top line or the inventory, so your net profit is very, very volatile, and it is it can just get wiped off. So it is not there in my list of coverage, and I would restrict my view on this.
Okay, what about you, Vivek?
Yeah. So this was again a company that we had discussed on this very show few months ago. So you brightly mentioned blockbuster IPO, and post IPO, I mean the stock had rallied from 600 to almost 2,300 levels, and now corrected more than 65% to 850 levels. But even now I don't find it cheap, even after almost a 65% correction. Although I'm very positive on the business. So I'll come straight to the valuation and then talk of the business and the sector subsequently. So even at the current price, the market cap is in the whereabouts of 2,000 crores with about 450 crores of, about 350 crores of debt. So on an EV by EBITDA on expected current year, that is financial year 18-19, it trades at about 14 times, but maybe about 28 to 30 times earnings for a company that will generate a return on equity of something in the whereabouts of 13-14%, which by no means is cheap. I mean 13-14% return on equity with the most optimistic scenario of mid-teens kind of growth trading at 28-30 times is still expensive for me. So even after a 65% fall, I still don't find it cheap in that sense. However, for the sector that it is into, it rides on the same macro theme that one would be bullish on a Cera Sanitaryware or a Kajaria or the plywood companies or the paint companies, which is riding on the aspiration levels of people to do up their homes, also on the real estate construction. And what Shankara is doing is consolidating the retail market of fragmented small retailers, hardware stores all over the place, to being a one-stop shop for all your building material needs. So from your plumbing to your sanitary ware to tiles to plywood, so on and so forth. I mean, Shankara intends to service all of that. Probably they can consolidate the market over a long period of time. So in terms of growth opportunity is very attractive. It's just that the valuation is not very attractive. And instead of Shankara, I may probably look at some of the companies whose products they sell. So why not look at the paint or the ceramic tiles companies themselves, who have also corrected 50-60%, or at least the ceramic tiles companies, the likes of Kajaria, have corrected that much. Paint companies unfortunately have not corrected as yet. So I continue to remain negative on Shankara and still not be a buyer on declines even at these prices. But I would monitor the growth going forward and see as to where I can get an entry point. But doesn't seem I'm going to get it anytime soon.
Okay, so that's the view that's coming in on Shankara Building at this point of time. Not the most positive view. We'll move on to the final stock, and that is the top pick in the hotel and entertainment space. So Vineeta, which is the top stocks that you're pushing in the hotel and entertainment space?
So hotels, we are seeing some kind of occupancy growth that is coming in. And but right now I don't have any stock in the hotel space. Yeah, in entertainment, one can, it's a small cap company. One can look at Saregama, and if you look at it, the company has now has two sorts of business. One is B2B, the other is B2C through Carvaan. So Carvaan has given phenomenal sales with gross margin of 22%. The sales is, they sold around 3.5 lakh units last year in FY18, and in this quarter they sold 2.8 lakh unit. And for the full year, the management is guiding around 7.5 lakh unit, which looks okay, which looks like they will be able to. And they have also launched 2 new variants of Carvaan. And if you look at so the company has established itself from a B2B, it has also established into a B2C segment, which has contributed to the growth of the company top line, bottom line growth for the past few quarters. The second is the B2B, where they have excellent, some good amount of songs and movies that they have done. And they have also been going into the B2B segment, in which they are also launching something called Yoodlee movies, Yoodlee films, which is doing pretty well, and they have a target of around 100 movies in the next 5 years, which they will be showing. So it will be a small budget movie, which will be released. They'll partner either Netflix or Amazon Prime, and then they'll telecast in that. So overall, I can see the growth coming in Saregama, which was a little, on the back foot. Even the balance sheet gives a lot of comfort. So there is nothing wrong with the balance sheet. So I think this is a company one can.
Okay, Saregama is the company that Vineeta is speaking about. What about you, Senthil? Hotel and or entertainment? Any stock that you like?
So within the entertainment space, usually it will be the broadcasters and distributors as a major pie in the market share. But now I think with Jio's aggressive stance, I think the entire entertainment industry is up for disruption. The indoor entertainment as per se. But if you go the outdoor entertainment, within the theme parks category, we like Wonderla Holidays.
Okay.
Particularly because they have a management quality as a track record. Plus, they have a good track record of capital allocation. So currently, they have 3 parks. The Kochi and Bangalore are mature parks. The Hyderabad park they started 1.5 years back. So they have acquired land in Chennai for their 4th park, which has been delayed because of some tax issues with the local government. So what they have done in the last 6-7 years has been utilizing the free cash flow from the existing parks and then putting up new parks. So as you know, theme parks is a very capital intensive sector, so one has to be very careful with the capital allocation say. So debt free balance sheet, plus the management's more focus on the development of indoor the rights at their own plants. So around 1/3 of their rights are developed by themselves. So they save quite a bit on the customs duty as well. So at present, if you look at the valuations wise, on a price to earnings, it is trading at around 25 times on your forward earnings, and the EV to EBITDA basis is trading around 12 to 13 times. So I think it's a long-term play, considering the huge upswing in discretionary income that we'll be seeing over the next 5-6 years.
Okay, and finally, Vivek, in the entertainment and hotel industry, what would you like?
Well, quite honestly, I don't like both the sectors itself at this point of time. Hotels, I've never really been a fan, and I'll explain the rationale as to why I don't see opportunities. You and the viewers of this program would recollect, I'm basically pretty sticky about companies or businesses that are able to generate return on capital which is reasonably high, and I have my benchmark in the region of 15 to 18%. None of the hotel companies have been doing that. They're unlikely to generate 15 to 18% return on capital or return on equity anytime soon. Most of them are debt heavy, is besides the point. So hotels, that's the reason I would avoid it. Within the entertainment space, if I were to look at the 5 different buckets, so we have the content producers. I mean, people who produce content for television or including film production houses is the same. The second is broadcasters. Third is the DTH and the cable television, who basically are into the I would say distribution infrastructure of the content. The last being multiplexes, which are basically exhibition businesses largely for the films. So if I were to now talk about each of these segments, multiplexes again suffer from low return on capital, low return on equity. The infrastructure companies, the DTH companies, the cable television companies, that's where the maximum disruption is going to happen thanks to what Reliance Jio is intending to do. So I'm not even sure, probably even the industry is not sure whether the current business model will survive another 5 years or so, or they may just have to align with any of the you've got telecom companies also providing this wireless or wire line with cable or without cable. One really doesn't know. The content producers are probably, whether it's television content, film content, or specialized content for online viewers, the OTT guys. Probably that's the most attractive piece, because the ability or their opportunity to monetize good quality content, now they have multiple avenues to do that. Except that only complaint I would have is that their revenues tend to be lumpy, especially the people who are also into film production. So the likes of Balaji Telefilms, and to give an example, will tend to have a lumpy revenue, that the quarter or the year when they have a large film getting released, and maybe subsequent year there's just routine stuff happening. The broadcasters is where they are somewhere in between in terms of disruption, the likes of Z Telefilms, who also produce content and broadcast. Probably they'll have a longer life in the disruption, but one is still not sure about their pricing power. So I'm going to avoid the entire sector altogether at this point of time.
Okay, so that's the view that's coming in. The 2 stocks that came out were Wonderla Holidays as well as Saregama. But with that, we're completely timed out on this edition of Hot Money. Senthil, thank you so much for coming in. Vineeta, Vivek, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.